Good morning, DEC members, and happy Monday to you all. I'm Steve Gregorian, President and CEO of the Detroit Economic Club, and it is a pleasure to have you with us today. A couple of quick announcements before we get started. I do want to take a brief moment to thank the 120 terrific DEC sponsors for their continued support of our mission. And be sure to get your tickets for our next two upcoming speakers. December 7th, Chris Whipple will join us to talk about his new book, The Spy Masters, How the CIA Directors Shape History and the Future. I'm reading it right now. It's fascinating. You won't want to miss that one. January 12th, after the holidays, our annual Michigan Economic Outlook meeting will take place. You also know we love having high school and college students with us, and I want to offer a very special welcome to students from Wayne State University, Schoolcraft College, University Prep High School, and Frontier International Academy. And finally, the DEC has an incredible history of speakers that we love to share. Our speaker today now joins a distinguished list of 10 other speakers who in our 86-year history have addressed the DEC on November 23rd. A few brief highlights. 1953, we were joined by Postmaster General Arthur Summerfield. And boy, oh boy, wouldn't we love to hear his thoughts on the post office today. 1970, American economist Elliot Janeway, who was President Johnson's economic advisor. And in 1998, media pundit Ann Coulter visited the DEC. And today we are pleased to add Mike Wells as our 11th speaker on this day in DEC history. So let's get started. Mike Wells is Group Chief Executive of the International Financial Services Group Prudential PLC, a role he has held since 2015. In 1995, Mike joined Prudential-owned Jackson, headquartered in Lansing, Michigan, where in 2011, he was appointed president and CEO. Mike has more than 3 decades experience in insurance and retirement services, including stints at Dean Witter and Smith Barney Shearson. He was born in Ontario, Canada, and earned a bachelor's degree in economics from San Diego State University. So Mike, you've been all over the place, but welcome back to Michigan, and thanks for being with us today.
Steve, thank you very much for having me. I've been looking forward to doing this, and obviously Michigan's been a big part of my career and personal experience, so I'm very pleased to be here today.
Thanks, Mike. So let's get started. When you took over the top job at Prudential in 2015, you were the internal candidate, having run Jackson for 4 years, and had been with the Prudential Group working in the US since '95. Yet in that global role, you're taking over one of the icons of the City of London, a British national treasure, really, and a business with its sights firmly set on Asia. How did you navigate the cultural differences and the difficulties running a business straddle across 4 continents?
So that's a big question and a good question. That I think let me do the personal. Let's listen to the corporate piece first and the personal second. So corporately, Pru was on a transition from a British-based firm with some international investments. Remember, there's 2 Prus for your audience: Pru Fin in the United States and Prudential PLC in the UK, which is at the time had an asset manager in the UK, a large insurer in the UK, Jackson National in the US, and insurance companies across Asia. It was the number 1 or 2 player in Asia. And I had worked on strategy and projects for the group since I got there. When we were smaller, we used internal talent to work on strategic reviews and things. So I have not only traveled extensively personally across Asia, but I'd worked with my colleagues across Asia for many, many years in the UK as well. So coming in as the internal candidate, you have experience, you have institutional memory, you have views of what you could change, and you have biases, right? Good and bad. I guess all biases effectively implies bad, but you are in a position where you have a view of what should be changed, and your learning curve, I think, is flatter. Now, on the cultural pieces, one of my views was we had to get more local and address some of the, embrace some of the things in the local cultures much faster. That meant decentralizing power, those sorts of things. And then, of course, it meant structurally going from global to, as you see, we're trending towards more Asia focused.
Great. So here we are, less than 3 years into your reign at Prudential. You announced the demerger of the UK and Europe businesses. And these are the operations around which the global company has been constructed over many, many years. The financial markets had speculated, Mike, on such a breakup for years, but you took people by surprise at the pace at which you moved. The spinoff of the business known as M&G completed about a year ago. What lessons did you learn from doing that transaction, and what advice do you have for business leaders watching today who are working or planning on transformation of their own companies?
So there's a lot of lessons in it. I mean, so demerging the original pieces of a 170-year-old firm, is a cultural event as well as a structural event, right? From an M&A point of view or a capital markets point of view. So you had to have very clear, very tight plans on how you would execute. There was about 100 at the peak, about 165 different projects required in that 18-month period to be completed, some sequentially, but most in parallel, to create an independent, demerged firm, which was the combination of the asset manager M&G and the original Life Co. You have to bring all your shareholders want management to focus on shareholder value, but when you get into these sorts of activities, you not only have to focus on total shareholder return, you got to bring every other stakeholder with you. Your regulators, the rating agencies, the employees, the consumers, they've all got to view that the outcome is fair to everybody. So the amount of work to make that happen is material. And I think one of the biggest changes, so I had a view going into the role that we could do a lot more at once than we were doing. Okay, I thought internally there was a little bit of blinders on the bandwidth of the company. And so I think that transaction proved we could do a lot more than we had. The other side of it is, as the CEO and as the exec team, you had to be willing to delegate authority quickly and pretty far down the organization, because there's no possible way 5 or 6 or 10 people could have managed live 165 projects. So culturally, that was a big transition for us, and we did it, and the team was amazing, and I couldn't have been prouder. And we had enough management bandwidth to staff 2 companies, which I think is a key consideration. And there's a point in which they become independent in their thinking, and it's before they're independent in their ownership. And I think that's a really interesting thing to balance. So keeping the agendas aligned until the last minute is probably the hardest and most important element of a demerger. And it's tricky. Everybody has their own view of, and it's a little bit like a divorce, in that, who gets the china and who gets the, in our case, it's the capital and some of the tech and things. And so you have to be very careful that you align your objectives between the firm that's going to be independent and the parent firm till the very, very last moment. And John and his team were outstanding to work with, and we got it done, and they're an independent company and doing quite well.
Great lessons. Thanks for sharing. Let's talk about Jackson a little bit. Within months of spinning off M&G, you announced a 2-way split will now become a 3-way split. Jackson is going to be separated in 2021. And we know Jackson employs 2,500 people just 90 miles up the road from here in Lansing, Michigan. And your planned transaction will mean a new Michigan headquartered company joining one of the New York Stock Exchanges. Now, Jackson is one of America's leading annuity providers. How do you see the future of the U.S. retirement market, and what is Jackson's role within that?
So I think Jackson's is a Michigan success story, and I say that from decades of experience, working with our office in Michigan, and I try to explain this to people that haven't spent time in the region. The work ethic you get and the support you get in executing in our Lansing office is unparalleled. I mean, it is everybody. The dimensions I could walk you through. You all live, but it's our most generous employee base with their time and their resources to charities and to people, to neighbors in need. And everyone knows someone who over the course of their working career is underemployed because of the changes in the industrial production in the region and things. So we're a growing successful employer that's gone from a mid-sized player to a market leader in the retirement market. And the employees are proud of that, and they've been a huge part of the reason for the success. That and the management of cash and capital. But it's if they need to stay and work because there's a huge day of applications coming in, they do. We make sure, from the healthcare to the benefits to the daycare center on the property, that those things are all consistent with what they need. And it's just been an amazing place to base a business. And I've had this conversation with people outside of the region 100 times. The other dimension, though, when you ask the retirement market part of the question, so if you think about part of the reason Jackson's successful is its core product, which is making sure that part of your retirement savings as income attached to it when you go to use it, and that you can't outlive that income, gets more important, not just with baby boomers, but with future savers, as interest rates get lower, as how to invest gets more complicated, and candidly, as the prospect that taxes increasing goes up, right? So tax deferral suddenly is worth more. All these things are tailwinds for Jackson, the core demand for its products and services. They had challenges to operating the business, but it's an extremely nimble and dynamic shop. It's got great technology. It's got industry-leading service, industry-leading distribution support, and it's been an advocate for consumer savings in the U.S. with some of the work the last couple of CEOs have done as well. So it's in a position where it's got a product the market wants. It's got capability to grow it at scale. And candidly, it's ready to have independent investors that are more domestic focused, who love, that segment, versus international investors who aren't familiar with what's going on in the US in that space, or would rather have a pure play on Asia. And that's part of the reason for the separation. But there's a lot of lawyers watching what we say about the separation process. Unfortunately, so I'm limited in the comments I can't make on it right now.
I understand. And thanks for your comments about us Michiganders. I think we're pretty strong, gritty, great work ethic, and glad you were able to experience it in your time at Lansing. So thank you. So Mike, I'm really fascinated by this journey that you've taken the company on from sick care to wellness. I want to spend a little bit of time about that because I think it's really interesting. Once Jackson is separated, the business you lead will be purely focused on the fast-growing markets of Asia and Africa. At the same time as transforming the structure of the Prudential, you've been transforming your offerings to customers in those parts of the world. We know the traditional model for life insurance is pretty simple. You cut a check if somebody passes or gets sick. But your vision, Mike, is rather different. You're using digital technology to help people prevent and postpone ill health. And you're trying to improve people's access to healthcare in countries where there may be a shortage of hospitals and trained professionals. So let's take a quick look at a short video that sets up our next conversation about your Pulse app, and I'll come back to you with a question, Mike.
Okay. Pulse is a highly dynamic health ecosystem. It's constantly evolving, but it's all about customizing the health experience to the consumer.
It allows us to live up to our mission of making health accessible and affordable. And I think that has real meaning and purpose.
So effectively, Mike, you are moving from being a sick care business to what you might call a wellness business. Huge transformation. Tell us more about this journey.
Okay, so let me go a little longer on this answer, Steve, if you don't mind, because I think there's some context that matters. So the traditional healthcare and retirement savings in most markets in Asia, I always joke, Asia is not a country. Like every market is individual, and every market has its own dynamics and policies, and Hong Kong and Singapore are quite different than Myanmar and some of the challenges we have. We localize completely. But that said, there are trends that carry across. So with very few exceptions, most healthcare and retirement savings in Asia is paid out of pocket. Okay, so when you hear about Asian savings rates in region, that's one of the main reasons. Medical insurance, as we think of it, say in the US, there aren't the equivalent of the medical codes your doctor's front office has to complete. And this is what my surgery in my arm was, an R11115 because it was this break. None of that infrastructure exists. Okay. So we go into a market where health inclusion and financial inclusion are social ambitions and political ambitions and individual ambitions, and they're all aligned for the most part. And that's a great thing for a business. So the demand structurally is there. as you have a growing economy, which is mean people have enough money to buy health protection for the first time. From a shareholder point of view, it's a very good business because it's relatively low capital strain and it produces very good returns, but you're actually doing something that everyone wants. So starting there. So old school to new school. So the core fundamental tool, one of the core tools in Pulse was actually created in the UK for a different reason. So you in your question, no market we're in has enough traditional healthcare infrastructure. Okay. But I would argue neither does the US. When we think of the Affordable Care Act, we added millions of people to the US, which is a great thing. We didn't add millions of doctors though, or millions of registered nurses or nurse practitioners. Same is true in the UK. The UK has a very good healthcare system, okay, but it's strained for availability and access. So a technology was built there that we use across 11 markets in Asia and 1 in Africa as part of Pulse, which allowed you to replicate the experience of going to see a general practitioner. And one of the amazing things with the UK model for research is they have an entire country's medical records end to end. So the accuracy of research on that is quite high, right? That's an incredible data set for the researchers. So that technology, we export it as a symptoms checker, not a replacement for doctors, work with doctors in local markets. And in Asia, they're open to scaling the existing medical infrastructure of doctors, nurses, hospitals with digital. The consumers are open, the caregivers, the doctors, the hospitals are open, the regulators are open, and the payers, which may be the government, it may be an insurer, or it may be the individual, are all open. Okay, so we created this mobile platform that helps you with wellness, that can triage if you should, if you're in Indonesia and you're 4 hours from a doctor, it can tell you if you should go take a telemedicine appointment, if you should drive that 4 hours, if it's already, those sorts of things. These tools are a part of what modern medicine is going to look like in Asia. And I think you're seeing them become more accepted in the US. It's harder in the US because of cross-state regulations and some of the complexities of our regulatory model. And I think you've seen less movement in the States than you have on the regulatory side in Asia. But for markets where, when we're launching this technology in Asia, we launched first in Malaysia in August of last year. We have about 12 million people have downloaded in Southeast Asia the apps, and we keep expanding the markets now that it's available. We're working with the ministers of finance, with the ministers of health, right, in these countries, and their request is to make sure it's free to, say, the bottom 40% of the population economically or things. And and socially, we're glad to do that. At our scale, forgetting those clients for a second, but with 16 million traditional clients, we can have a tremendous impact quickly with these sorts of tools in region when there's a crisis like COVID. So there's a lot going on here, and there's lessons from established markets that we've dropped into, emerging markets, if you will. And there's trends in emerging markets like the acceptance of digital payment and digital devices as part of a process that we're levering both directions. But it's been well timed. I'm glad we had it up and running for when COVID hit. It's been, I think, very valuable to people in that. And we continue to add functionality. We continue to add capabilities to it, and it's very dynamic. And we every Friday we launch a new capability to it. We go live every Friday with another element. So culturally, for a firm 170 years old, again, that's a really good experience for our teams to know that they need to be innovative every single week in that space, and they are. So there's a lot going on here, and I'm really proud of what our folks have done in this space.
Sounds very innovative and aggressive, and I love the Friday schedule. Congratulations. You mentioned COVID. Let's finish up before we go to audience questions on some COVID talk. So like every company, Prudential has seen the way it does business challenged. How have you adapted, and what do you think are the long-term implications of this pandemic, particularly in healthcare?
So, from a corporate point of view, at our peak, we were 95% work at home on over 18,000 employees globally. And each country has been, our China businesses were affected early. They never fully locked down. The banks in China were allowed to, have about half the banks stayed open there. So we kept some distribution, but we've had full lockdowns. Definition of lockdowns, as it does in various states in the US and countries, vary considerably. So we have to adjust constantly. So we're much better at opening up fast, and we're much better at being less impacted by closing. So for example, all of the regulatory markets but one have approved our agent and bank channels ability to sell virtually like we're talking now. And we have the technology to support that. Our employee wellness programs have become critical because, you know, in some of these very expensive, dense cities, we have employees living in very, very small apartments with no windows that open. And that's really hard for somebody with weeks of lockdown. And so, you know, our mental health support services for employees, these things have become critical. And I think there's a lot to learn. You know, COVID favors established players, right? If you have established relationships, this was easier. If you have established distribution, regulatory relationships, investor relationships, they're much more forgiving than if they don't know you and they're trying to create tension. So again, some of our strength comes from how old we are, how long we've worked as a team, the people we know, and that's an element of that is just luck. You know, there is no. I see it all the time in my calls. Personally, real quick, so my day is longer. I think there's very little weekends, if there ever, you know, whatever weekends were, they're not anymore. And our footprint makes calls at all hours of the day. My first one this morning was at 3:30. You know, that's the nature of what we do. But you're traveling less. I've gone from almost 200 days a year on the road to, you know, I traveled quite a bit in the last 9 weeks, but it's for the year, it's very, very low travel. And after, to your question, I think our corporate travel will be down materially. And I think healthcare will stay virtual to a great degree and will stay digital to a much greater degree. I think people are learning telemedicine is safer if you're afraid of, you know, being in a doctor's office or hospital. And I think they're also learning that if you don't like waiting for your doctor, sorry to any doctors on the call, but a telemed appointment usually starts on time and ends on time, which is not always true of, you know, the medical process in a traditional office. So there's a lot of advocates of it coming up in pretty much every market we're in. And I think that's here to stay.
Well, those trends bode very well for your Pulse app. So I'll be watching that. Congratulations once again.
Thank you.
That's it for me. I wanted to switch over, Mike, if you would, to some audience questions.
Certainly.
Thank you. And so these are questions that were submitted via email from some of the attendees. And folks on the call, if you want to use the chat box now to send in live, I'll try and take a look at that as well. But this first question comes from Derek, who is in the insurance industry. Do you worry about Amazon entering the insurance space?
So Derek, it's a great question. Amazon, Google, and, you know, in China, you have Alibaba and Tencent. They have done different things, I think. All those giants tend to, there's a couple of natural barriers. You know, let's split insurance into them being a platform to distribute. They do a little of that now, and much of those players, they usually reduce the brand of the insurer on that platform. And you know, we've not seen any material shift in the success of that model. We have one competitor, an excellent competitor in China, Ping An, and they are one of the most digitally savvy firms, I think, in insurance. And yet most of their life insurance and their traditional product is sold by their agency force. Okay. So I think advice is still important on big decisions for consumers. Where I do think you'll see them in the health space, and you're starting to see this now, is pharmacy. We use digital pharmacy delivery in Southeast Asia, where, you know, after the appointment, the prescription shows up at your door. It's not hard to do with an Uber-like driver and a warehouse. And I think the profit pools on the pharmaceutical retailer space are larger than some of the, say, Derek, than your commissions if you're an agent on the insurance space. And I think those firms look at profit pools first and look at their technology disrupts. So can Amazon deliver pharmaceutical? Absolutely. They have investments in that space now they've just made. And, you know, do you believe they could manage inventories and get a prescription to your door quickly? They can, right? So I think that's probably the space you'll see them be a material disruptor first before they get into a highly regulated advice space. Most tech CEOs I meet marvel at the number of regulators that I deal with in the course of a week. And, you know, that they're in a highly unregulated space historically, more regulated currently, but that's been, you know, we deal with 100 regulators, you know, our global footprint, and that is an interesting concept to particularly a smaller tech firm starting up.
Thanks, Mike. JR is with us. He's in the financial services wealth management industry. And his question is, what impact have low interest rates and regulatory changes had on your business?
So JR, thank you. It's so low interest rates generally are hard on insurers. And I think our accounting methodologies generally use interest rates as part of the calculation of how valuable your future earnings are. So if you look at them from a cash point of view, you may get a different answer than if you look at them and what the discount rate is for those that are a little closer to it. So that's an implication. I think this year you saw every major financial metric move that challenge insurers. You saw, market volatility at unique levels. You saw equities go down and then up again. You saw spreads of bond on the yield on a bond, if you will, go open and close on for the relative credit, and you've seen rates move. So insurers generally are better as a category. Again, with our public listing, I can't get too much into Jackson, but it is insurers are better with rising rates, but not spiking rates. Okay, because remember they own large bond portfolios. In our case, a lot of the U.S. business is variable annuities. So the major impact for any variable annuity provider that hasn't written an income interest rate sensitive guarantee it's the discount rate on your future earnings. So for some period of time, it may give a lower than will be the historic rate or the likely performance over 20 years. Those sorts of, you get a little bit of a skewing of that. More importantly, I think, I'm sure you're dealing with this at JR, is investors, individual retail investors ask me all the time, what do I put the safe money in? Friends will, and I know how hard that your job would be this right now, because the old, it's been a couple of articles lately that the old 60-40 equity bond, or take your age minus, 100 minus your age and the percentage of bonds right now are not producing a lot of economic return. And relative to inflation, that's a very challenging space. And I think consumers are moving further out the risk spectrum, and that's not healthy to replicate that yield. So we see that. And again, I think our products can help with that, but only to a certain degree. We're a part of a solution. We're not the solution for a retiree.
Thanks, Mike. And a final question from Andrea. Has the way consumers have viewed life insurance changed over the years of you being in the industry?
I'd like to say, Andrea, that it's gotten cool and hip, and that most people go, I wish I'd have gone into insurance when I was your age. That's not been the case. It's no, that's a great question. I think there are incredibly clever new types of life insurance emerging and models emerging. And they're global, and they reflect the regulatory policies. And we're not in the property and casualty business or the insuring risk of loss of something physical business, but there's some clever things there too. But if you say, do consumers want an innovative retirement? I'll give you an example. If I go to a conference of CEOs and I want to be left alone to do some emails at dinner, I tell people I sell insurance and the table clears. If I say that if I want to talk to people about what we do, the same thing on an airplane. If I want to be left alone to read on a flight, I just put my hand out and say I sell life insurance, and I generally have plenty of privacy on the flight. If I want to talk to someone that whole flight, if I say we're working on financial and health inclusion across Asia, and we're trying, and at the same time trying to help U.S. retirees bridge their savings gap to their ever-growing life expectancy, they'll talk to the whole flight, because everybody has a view on what they should be doing with the retirement money. They don't usually know a lot about the challenges that are in Asia structurally, and they're very interested in that. And so it depends how you look at it. But let me give you a couple of innovative things that are going on. So some of the firms that are Northern Asia stopped using the word insurance. So I can ensure that if my flight is late, that I will get a cocktail or I'll get a cup of coffee. I can ensure if I'm late for a meeting. I can ensure if the weather will be good on the day I'm going to be married. Okay, I can ensure, and so these things are, when I talk to regulators in these markets, they're constantly looking at the tension. Is this gambling or is this insurance? And there's a fair question. That's always got to be an insurable interest, but it's what consumers actually want. And they don't think of it as insurance. They think of it as addressing a concern they have or a risk. And I think as the industry gets better at letting go of what it wants to be and being more what the consumer wants to be, you're going to get a very different outcome. The last thing I'll tell you, domestically in the US, you have Lemonade and some other very clever companies on the property and casualty side that are saying, look, here's how much money we make. If you make claims, we're going to make less. So I'll tell you what, we'll give a piece of it to your charity of choice. Okay. Boys and Girls Club, Lansing. Okay. If you don't make claims. If you make claims, we won't be able to do that. And they put the burden back on the consumer to manage their claims. It's working very well. Okay. We'll see if it's scalable. It's an interesting idea. We've been watching them for 5 years, meeting with their teams and things. And, it's a very clever model. There's all sorts of things like that going on in the States as well, that the consumer looks at it and says, I like that better. Right. I'm okay with you making a profit if I can decide where some of that goes. They're not for everyone. They're not, there's no single solution here, but there is some innovation in the States, and there's lots of innovation across Asia, and across Africa. We address, again, what people's primary social needs are. If you've, in Ghana, one of the biggest issues for families is a funeral. It's a transfer of relationships in the family. It's a big deal. It's sort of the original. So, it's in some ways it's family crowdsourced. If you've never looked at a casket in Ghana, it's an interesting thing. You're buried in something you were very interested in life, right? So if you love to fish, you may be buried in a coffin shaped like a fish or a boat or something, and your whole family gathers and they talk about restructuring your role. Well, that is a much different event to insure than the cost of a funeral in the United States, again, which is not a business we're in. But when you're local, you can do some very innovative things in that space if you just relax your historic lessons and say, all right, what does the consumer want? How much of it can we help with? And you need the regulators to come along, right? You need the regulators to say, okay, I get that demand. But we do that, and it's worked very well.
Well, Mike, we promised we'd only keep you for 30 minutes so you can get on with your busy day. So a huge thank you for your insights and time. Continued good luck. We'll be watching the Jackson transaction, and we'll watch how the Pulse app is going in your business in Asia. So good luck with all of that. And we hope to have you in person with us again someday in the future, Mike.
I look forward to that, Stephen. Thank you for having me today. I appreciate it very much.
Our pleasure. And I would also like to thank Jonathan and Addie from your team. And thanks to my team and for all of you out there for being with us. Hope to see you all December 7th when we host Chris Whipple. Have a terrific holiday week. Stay safe. See you soon.